Okay, everyone, welcome back to another episode of Line Your Own Pockets. Today, I actually had to interrupt a conversation me and Dave were having in the green room there and said we got to turn on the cameras for this because it was already getting a little bit interesting. We're answering another question that we got from Twitter from a gentleman called Day Trading Zoo, who was actually commenting on one of my videos about how to potentially change position size when strategies are doing well and doing poorly. And yeah, as I mentioned, we were talking about as we're getting ready for this, and we're already starting to have some disagreements and chat about it. So I think this is going to be interesting. So first of all, what do you think of the comment? And then we'll kind of dive in from there.
Um, yeah, I thought it was a great comment. It's a very common thing among traders, especially systematic traders, because there's a tendency to look at the overall market and figure out some correlation with a specific strategy. So, for example, I've looked at this a ton over the years. So, I've was trading or still trade a gap strategy. So sometimes I'll go long with the gap, sometimes I'll go short with the gap. And there's a tendency for traders to look at, okay, well, let me just see what the overall market is doing, and maybe I'll turn off or on the long side or the short side, depending on what the overall market's. So it's very tempting to look at that and think that there's going to be an awesome correlation and rule that you could apply to your strategy to improve it, and the game's over. But it's much harder than it seems like it should be, and there's a whole lot of caveats that come with it, even if you find some way to logically turn off and on a strategy based on the overall market. So it's something I've thought a lot about, and I'm sure we're going to have some disagreements here, but
Oh yeah,
so I'm
and
curious
I'm
about this conversation.
I'm excited for it, right? So just to really break down the question, basically the gentleman was saying he's a fully systematic trader, and what he's finding is that there's periods of time where some strategies do well, and there's periods of time where some strategies do poorly, and was basically saying, when do I potentially size up in a strategy that's outperforming, size down in a strategy that's underperforming, and it's interesting because I think what our difference is going to be when we're having this conversation, and everyone has to keep in mind, is that Dave is primarily a day trader, right? In and out. Well, I'd say exclusively a day trader. I am primarily a swing trader and trying to branch out into the day trading world. So that's kind of the first differentiation I think you're going to have to pay attention to, because I my argument's going to be that someone who has backtest and run a lot of systems, especially long only trend following systems, if you're trying to take part in a long only trend of a stock breaking out during 2000, 2008, right, even some 2022, 2023 action where the market was primarily down, those systems dramatically underperform, where you have other systems like mean reversion type systems that dramatically outperform. So the complexity, and I think where the back and forth is going to happen, is the ability to predict when and if those things are going to happen. So I'm going to say that I am pro regime filter as long as we're talking swing trading or longer, and as long as it's an easily definable thing. So for example, some of my trend following strategies will just say, if the S&P 500 is below its 200-day moving average, don't trade, right? Now, does that make sense to you? And that's, if you were more of a swing trader, is that something that you would kind of reopen your eyes to, or would you just still be dogmatic about not doing it?
Um, Dogmatic's a strong word there, but I think it's not that I'm fundamentally opposed to using a market filter. It's that I think with my strategies, I feel like I can do better than to resort to using a market. If I have to resort to using a market filter or a regime filter, to me that means the system that I've designed is too reliant on the overall market happening to be in some arbitrary situation for it to work.
Hmm.
When I design a system, I want the signals to be strong and unusual. And if if for those to work, it needs the market to be in this precarious specific situation, then I feel like I haven't done my job in creating a signal that's strong enough. That system should be able to stand on its own, and that signal should be strong enough and unusual enough to stand on its own without relying on the overall market to be doing a certain thing.
And from a day trading point of view, I think that makes sense, right? Because when, generally speaking, when you're day trading, you need your instrument to move, as you mentioned, in some sort of a way. So that's generally a news event, large volume coming in, a gap, something like that. When you're trading a little bit longer term, the correlations I think increase. So I think basically what's happening is that you're looking for shock events that break the correlation between whatever instrument you're trading in the overall market. When it comes to longer term in nature, those shocks even out, right? I don't care if you have the best company in the world. Like you can use an Apple, for example, right? It's during a bear market, there's going to be some degradation there, which again makes perfect sense. Now, the question I would have again from a day trading standpoint is what if the data was really extreme? Like what if you had 10,000 trades in your back test and you noticed if the market's gapping up, every single time you trade, it's wrong. And when the market's gapping down, every single and the data set's robust, it goes back in time, it goes, is there any amount of like binary type data like that that you'd go, okay, there's definitely something going on? Or would you just say, maybe I should just trade the overall market with this strategy?
Of course, I mean, if I saw correlations that great, of course, I would use it, and the reason I don't is because those don't exist, and I've found more rules that I can apply to a strategy that actually make sense and are very much correlated with the signal itself, um, and have and make sense when you consider the signal itself, which is a huge part of why you make a rule in the first place in a trading strategy. It has to make sense. It has to tell a coherent story along with the signal itself. And to me, it's a big leap to say, okay, the signal is such and such, but the overall market has to be doing this. That all of a sudden, that's not as a coherent story that I can tell myself and that I can really get behind for that signal. So,
And I
of
think
course, if
that's
there was perfect data out there and yeah, it would perfectly correlated with the system, of course, I would trade that rule, but that doesn't exist, and that's the problem.
well, yeah, and I just asked that question just because I knew the answer, just to show the audience that it's not that there is some sort of a you have an aversion to it in some way. It's just that I like the idea of the story, and this is something that I talk about all the time when I'm talking to traders who run back tests and do that. Is that you need to make sure that whatever you're adding to your system or subtracting to your system, you could sit down and kind of explain to yourself. Like it doesn't matter if the numbers are saying, hey, add a MACD to it. If you're like, well, it's not a trend, it doesn't make sense if you can't justify it to yourself. So I think that's kind of the first thing to answer this question is when do you size up and down on a position? Well, it shouldn't be kind of arbitrary based on the market. For my example of a long trend following system doing well when the market is trending higher, that makes sense, right?
Yeah.
Leaning on a mean reversion or pullback type system, if the VIX is higher, that makes sense, right? Because you're going to have more of that action. So if you're looking to size up or down in certain positions, I would say that looking at the individual filters would make more sense than looking at a regime filter overall for day trading, which based off this user's name, I think he's talking about day trading. What I would think it would make the most sense to look at is other related patterns on when systems are getting through these drawdowns. So, for example, are you someone who's trading a lot of earnings events? And when earnings season is more slow, right? There's not really a no earning season. It's like earnings always reporting, but there's times where there's a lot of earnings and there's times where there's a little bit. Is it something like that that makes more sense as opposed to what direction the market's doing or what each individual name's doing?
Yeah, I use earnings filters in lots of my strategies, so that doesn't fall into the bucket here of what I'm referring to of overall market, like what the SPY is doing today.
Right.
Um, and here's a question for you, Michael. You said in your example before, you got a trend following system, you're holding many days, it's long. Of
Hmm.
course, that's going to be correlated with the market. The more days you hold, the more it's going to be, the more it makes a coherent story to do what the market's doing, which is going to
Yeah.
overall is going to be going up over time. Do you do any Do you have any short trend following systems that you do something similar with? I mean, I think that would be much harder since bias for the market is up, the longer the more you zoom out.
Yeah, I have yet to find a swing trading system that I like from the short side, because my thinking behind it is that not only do I need to find something that has a positive expectancy that I can backtest for a long period of time, it has to make me comfortable with the overnight short risk, right? Which, everyone knows stock can only go to zero. If you're splitting your name, if you're splitting your portfolio like I do into 20, 15 to 20 stocks, if one of them goes to zero overnight, that sucks, but it's not a massive unrecoverable hit. The inverse can happen where a stock, right, look at the like drug or whatever happened recently, a stock went
Yeah.
from $1 to $50. I don't want to do that. So for me to find something from a short side of things, I need to really make sure that I'm covering that additional risk with additional gain. So it's why I'm actually kind of interested, and I'm sure we're going to do more on this going forward. My exploration back into systematic day trading, I'm interested from the short side, because holistically that would make a lot of sense for me if I'm um, specifically focusing on intraday shorts, and then at the same time I'm doing daily and long term long positions. I think that would kind of hedge my overall life, but um, yeah, I haven't been able to find. So for me, and just to bring it back to the question, I think for me it's more of an on-off filter makes way more sense than potentially a long short filter. So with this particular strategy, it is again simple: a weekly close below the 200-day moving average on the SPY. Don't trade this strategy until it recovers.
Yeah, well, so if I were to use a rule like that, I would wanna go and test the heck out of it to see. I mean, that's not it's like it's a question you can get the answer to, right? You could do
Yeah.
a back test and see exactly that, and when you do that, um, here's probably the main reason I don't use market filters. Um, when you go and do that back test, and let's say you come up with a rule that says, okay, VIX over such and such, turn the system on. You're going to have weeks, months, perhaps, where your system is not trading at all, just
Hmm.
for some arbitrary rule. There's going to be trades that would have happened in there if you didn't have the rule that were profitable. Um, But I'm just uncomfortable turning a system off like that based on what I think is a pretty arbitrary rule. And, I want systems that trade frequently, every day, hopefully, and um, that are not correlated with the overall market. So, part of my process is thinking about that from the very beginning. And every rule I apply to a system, I'm thinking about that. I don't want to have to look at the overall market. In fact, I don't even have a chart of the SPY or the overall market at all on my computer at any moment. People ask me what the market did today, and I'm like, I don't know. I don't care.
So
It's just nice to be able to do that. Like this other factor that I can. It's not easy, but I've worked hard to be able to avoid that because the same sort of um, discretionary decisions you make or you end up making and screw things up, I feel like I would do that with the overall market. There's always some sort of story you can convince yourself that, oh, the overall market's doing this. Better turn my stuff off, or it's just it just all seems so arbitrary to me.
Well, so for your example of when you turn a system off, it's no longer trading. But what if, and this is, I just use this because it's my example and what I do, you have other systems that will flick on during that time, right? So the idea is to use your VIX example, VIX over 20, I'm no longer trading a trend following system, but I replace it with this system instead. Or again, like the question mentioned, maybe size up in different systems, right? So uh, if it's not a binary on off, does it make sense, or would you ever consider maybe a risk allocation change? So I have three systems. Maybe I know these two systems work really well in gap down markets. So I'm going to maybe apply a little bit more of my buying power to those and a little bit less of my buying power to this one. Does that make any sense to you? Where there's, maybe you've got a limited amount of buying power, and if the listeners are just envisioning like a pie chart, right? And that's your buying power, and you're just opening up different parts of the buy or of the pie chart based off what you kind of see, based off the volatility or something that's occurring out there.
So there's a couple things you said there that, in theory, if it worked out that way, yeah, that'd be great. You could have this magical thing where it turned these on, but these off. Like when you go and look at those strategies and do the analysis to figure out what that overall market filter would be in theory, you're going to find that there's not one level that works perfectly for all those strategies. So there's not going to be this one magical level. They're all going to be very different when you look at each strategy,
Hmm.
which is another reason why, is that really a coherent story? I don't think so. Um, but the other thing you said was, is there really a difference between sizing a strategy up versus back down a little bit, or a regime filter where you're literally turning something off and turning another system on? And to me, that's pretty much this exact same thing, right? You're When you have a regime filter, you are sizing your positions differently. The position size is just 0, right? Instead of what it normally would be. So I think those are 2 sides of the same coin, and, um, it's like you the example you posed to me about, in theory, if you could figure out that this filter worked perfectly, would I be opposed to it? No, of course I wouldn't be opposed to it. But in reality, I just have too much experience looking at these systems and trying to find something like this that would work well. It's I just there's so many downsides to even finding one that works. There's trade-offs there. So I'm just being realistic about it, I feel like.
So the other question that I'll propose, because this is something that I actually heard. I was hanging out in the Real Test forums, which is we'll get to, the back tester that I use, and they were talking there about potentially using something like the equity curve itself as a sign whether or not to trade or not trade the equity curve, or to size up or down. Like, so for example, I've heard people say, I'm going to, put a 50 period moving average on my own equity curve. And when it's under that, I'm going to flip that off and say, hey, it's not performing well right now, and then flip it back on. That to me at least seems more systematic, but I really haven't thought too much about it. At first glance, I'm like, that seems a little wacky. I don't know if that makes any sense. But have you ever explored that in any way? I guess just to explain it further for the listeners, you would run your back test every day as normal, and you would chart the equity curve of that back test, and you would put a moving average on that chart. And when the back test looks like it's degrading and doing worse than what it does on average, you would either assign less capital or turn it off. And then when it looks like it's performing well again, you would turn it back on. Any thought to that, or?
Yeah, I've actually wrote an article about this several months ago. I'm totally opposed to the idea.
Yeah.
It doesn't make any sense to me at all. Like, if you designed a system well, the signals don't care what your equity curve looks like, right?
Hmm.
It's completely arbitrary, even more arbitrary than the overall market itself. So it just, we talk a lot about keeping systems simple. Just simple is better. this is a huge step in the wrong direction. You're shoehorning some arbitrary result into into your system for no good reason. Um, yeah, it just seems completely arbitrary. It's sort of like you hear some people look at or think about streaks in their system. So if there's a certain streak, you'll turn it off. Like if it does really well, maybe it's not going to do well likely in the future, so you turn it off or you reduce size.
Yeah.
Completely arbitrary. Like if you look at the numbers, like it's completely quantifiable. You can go test it and see if how streaky your strategy is, and test it and see. And I've found very little evidence of any streakiness that can be exploited in any way in any of my systems.
Yeah, I'm just gonna agree. I just thought it was is interesting, but I'm gonna agree full-heartedly. For me, it kind of seemed like betting heads on a coin flip because the last five were tails. It's like there's a human inclination to go, okay, well, this thing's occur, but it's like that coin flip is just as random as any of the other ones. So why bet this because those other right are going to roulette wheel and go, oh look, it was black, 10 times in a row. It's got to be red at some point. The martingale strategy, for example, and then all these things that we know that just mathematically just don't work over time. So I guess that would lead to, and this is, I don't know, maybe this will be a giant topic for another one, but there at some point has to be a kill switch for a strategy. Like at some extreme level, there has to be. I always like to bring up the example of the odds lot indicator. I don't know if I explained that already before, but back in the day, they could use this indicator and say retail's buying this stock, not institutions. And this was a very classic and did well as a systematic trading strategy. Then at some point just stopped working, right? Hedge funds and institutions caught on and it just broke down entirely and it will never come back. So I guess when do you know that that has occurred, and what is the cutoff, or is there even something that you can use systematically to say my strategy's dead, it's time to move on, or is it just something that you have to kind of just feel for a long time and have it draw down and go, okay, I need to do something else.
Yeah, it's so I went into a drawdown several years ago, which completely sucks. And it gave me the motivation to come up with completely different workflow for answering this question. And what I came up with was, a way to optimize my strategies much quicker than I have before. And as part of that, I come up with a roadmap for myself for each strategy. So I have different rules that I apply to the strategy. And when I get to the point where I'm ready to go live with it, I don't stop there. I create a couple more rules that I sort of hold in reserve that I know I'll be able to go back to in the event that it draws down, and that I can apply to the strategy to improve it a little bit further, but reduce the number of trades in the system. And it's incredibly valuable because you avoid the situation where you feel like you're in a dead end and there's nowhere to go and you feel like you want to quit. When a strategy goes into drawdown, you're kind of out of ideas. This avoids that situation because you sort of hold these rules out and have a plan for it when a drawdown comes. So it's just a way better way to do it because that decision you're talking about, turning a strategy off or abandoning it, that's a very difficult thing to do, and it's a very a lot of systematic traders think you can avoid emotion, but that decision you're talking about right there is a very emotional decision. It's probably more emotional than any decision to take a trade or not in any on any given trading day. I mean, it's a very emotional system. That's making that decision is it's almost like an identity crisis, right? It's a very personal, very difficult decision to make. So I want to be prepared for that and sort of have a plan in place that I can go back to and sort of continue the optimization process for each system I have. That
Yeah,
makes sense.
Yeah, and it's a lot that, there's the sunk cost fallacy with it, right? I've spent so much time and energy building and refining and trading and testing this that it's time to go. But I like the idea of always just holding something in reserve because what you'll find is as you become more systematic trading, is that you're running everything as normal. That's just continuing to go, but your brain never stops. So you're always thinking of new ideas of ways, things that you could do that strategy. So you kind of use if it ain't broke, don't fix it to simplify it. I have, you say, okay, I've got these three ideas that I think could make the system better, but instead of implementing them right now, I'm going to wait till the system is doing great now. I'm going to leave it alone and just and let it work. And then if it starts hurting me in any way, then I'm going to try rule number one and see if that fixes it, and try rule two or rule three. I guess the only thing is like, but if you could make the system that much better right away, that would have to be very tempting to just go and implement those immediately.
Yeah, well, there's a before I forget, there's a great quote that I just heard recently based on what you said. You said, "If it ain't broke, don't fix it."
Mm,
The quote I heard was from Paul Tagliabue. I think he was the NFL commissioner for many years. He said, "If it ain't broke, fix it anyway."
mm,
And that's a good way to look at your systems. It's a lot of these decisions about when a strategy is ready to trade or not are very personal decisions based on your risk, based on the other strategies you
yeah.
trade, based on your experience. So there's not going to be this right answer that you come across and that's the right answer. Like you get an A on the test. You're never going to know that the rule you're putting in place is the optimal rule because it's that varies, it changes over time, it
Hmm.
based on your risk profile, et cetera. So there is no right answer, which is what makes trading hard, but it
Yeah.
also is what makes it fun.
Well, and that's yeah, because it's his ever going problem. The last thing I wanted to just talk about when you were the statement you made previously about the emotions is that a lot of people I find that I've talked to more and more approach systematic trader trading because they say I want to remove the emotions from trading, and they also I think there's some perception that it's less work. And although I'd say it's way less screen time, I would say neither of those are technically true. They're kind of true, right? So the emotion of every single trade goes away because you're not there for it, right? A system's handling it, but the emotions of still seeing drawdowns and the ability to stick with a system even after a period of losses and things like that. There's still a lot of emotions that go through. You look at your P&L at the end of the week, and maybe it's red. And there's a temptation to go in and change things and tweak things, but maybe you go back and you look at your system. You say this is just par for the course. It's just what happens, right? So you continue. So there's emotions there, right? And then the work, although you're not sitting and staring at a million charts and hitting buttons to buy and sell in every tick, the work is still there, right? It's still going to take you, probably maybe some time in the morning to set it up and some time in the evening to review it. But then what you'll find is if this is something you're truly passionate about, you're always thinking about it. You're always, wanting to come up with new ideas and learning new things and do all that. So just because you mentioned that emotion there, I want to say that in some respects, systematic trading removes emotions, but it just kind of puts those emotional decisions somewhere else. You have more time to make them, so maybe it's a little bit easier in that respect, but it just moves them, moves them down the line a little bit.
Yeah, I think you're exactly right. You spend lot less time making decisions during the trading day and a lot more work outside of market hours to, design systems and think about them and which is easier, right? You have all the time in the world after hours and there's
Yeah.
no there's no data coming in that you have to react in a certain amount of time. So it's a for a certain kind of person, that's definitely the right move, and it's a lot easier and a more logical way to think about the markets.
Yeah, it's less of a pressure, I have to do this thing right now, and more of, oh man, I gotta sit, well, by my thinking spot in the woods for 2 hours and just,
Mhm.
contemplate what I do. So,
Yeah.
but yeah, still emotional. It's still, I'd say, the same amount of effort required. It's just different. So, I just wanted to touch about that, and I'll probably do that a few times just because I hear so much people saying, oh, I want to get into systematic trading because I'm a very emotional person. I want to remove that. I just want to go, okay, you can change that, but you're still a human, so you're still going to be emotional about certain things. They're just going to be a little bit
Yeah.
different.
Yeah. So I'm reminded. I was just looking at my notes here, and I wanted to get in one more thing. Part
Sure.
of the reason that I feel this way about overall market filters is I've spent a lot of time a few years ago trying to come up with a system that traded the E-mini, so the S&P E-mini contract.
Hmm.
And I looked at, 20 years of 1-minute bars. And even when you look at that much data, my conclusion was even then, like every day is pretty unique when you look at a single contract. There's not, I think there's a lot fewer patterns that generalize. So my conclusion was, it's even more arbitrary. Like it made it clear that this is sort of arbitrary. There's not repeatable, common, predictable, profitable patterns to look at versus looking at the overall US equities and trading a strategy based on that. So as part of that process of diving deep into that for a good while, I gave it a good effort. And it wasn't like there weren't profitable strategies to find there, but they traded infrequently, and there wasn't a lot of data back up any specific setup because the days are and those setups are pretty unique when you drill down far enough. So it became, I don't know, I sort of got a little bit disillusioned with it because of the data was telling me that.
Well, yeah, if you can't find an edge in the thing you're trying to make a regime filter off of, then it doesn't make sense for it to be a regime filter. Then that makes perfect
Yeah.
sense, right? If I'm trying to predict X using Y, well, if I can't predict Y, then I can't use it to predict X. It just won't make sense. But
Yeah.
and you can see how that would be different, which I think, we've just realized that the difference is basically just time frame. For me, you can see there's many historical bear markets that have happened through time, and they all, first the stock has to break down the 200-day moving average, so that would make a little bit more sense. But intraday, the market is more erratic, and I would just say it's because it's more efficient, right? What we're trying to do is exploit inefficiencies in some way. So if you're dealing with a market like the S&P 500, which has to be one of the most liquid and efficient markets on planet Earth, it's going to be harder to do some sort of prediction on that, and then that's going to be harder to kind of translate that prediction down to using it as some sort of filter to help predict overall stock prices.
Yeah, for sure. It reminds me of one other situation I want to touch on, which is um so in my gap system, looking what the overall market does, thinking about turning off the longs or turning on the shorts based on what the overall market's doing, and say like the gap in the overall market. Um, it was completely arbitrary. Like you could come up with a story that said when the SPY's gapping up, well, longs are more likely or less likely to work, right? If there's a big gap in the SPY. And some days the longs would work better, some days the longs would work worse. And sometimes when the market gaps up, it fades, sometimes it continues. So it all like it just seemed to confuse things a lot more and not really bring clarity to any sort of rules. So it just again, just more arbitrariness that seemed to overcomplicate the systems.
Yeah, so at the end of it's got to be a story that you could explain in some way. I remember when I first started to learn to trade discretionarily at the prop firm, um, the one of my mentors always said you should be able to explain your trade to a 5-year old of why you bought and why you sold in some way. And it's kind of the same way if you're saying you can't explain why this particular filter would make sense. You could make, 5 different stories and they'd all end up making sense to what you're doing. Well, then you haven't really achieved that goal. You haven't narrowed that in place.
Yeah, I like that concept, being able to explain it simply to fifth grader or maybe even better, like a skeptical trader.
Mm.
I think that would be a good person to have to explain it to, and if that person doesn't think it's a coherent story, then you should probably think twice about the rule.
Well, yeah, and he would this particular the gentleman who ran this prop firm, he would do that. He would walk up and he'd tap you on the shoulder and he'd point at a position. He'd say why you're in there, and if you couldn't very succinctly explain, well, the stock's gapping up, it put in this typed opening range. I think the news is good, and blah blah blah. If you couldn't do that within a couple seconds, he'd make you close it down and go home for the day. So it ended up being a pretty good teaching tool as well because it was very easy to enforce. So it might be an interesting exercise for yourself if you're building a system. Try to explain it to the wife who or someone who isn't familiar with the world and say, "Oh, I think it makes sense. This is why I'm trying to do this certain thing because right, the stocks get too oversold and people think it's a good price and they buy them and right, that's my mean reversion system. Or the stock did very well last week and it's pulling back this week. That's like a pullback system, right? These type of things that you could look at in order to make sure that whatever you're doing kind of has some sort of cohesive sense.
Yep. Yeah, I love it.
All right.
Alright, that a good place to wrap it up here, you think?
I think that's great for this week. I start to hear a child screaming in the background, so
Yeah.
that's just part of my life as a stay-at-home dad with a sick kid. So I think it's probably a good time to
Yeah.
wrap it there.
Okay, I've got a couple links to some articles I've written for my newsletter that, apply to this topic. We'll put those in the show notes, and, yeah, I love this topic. I think it hits home for a lot of traders because I know that as soon as you start to think about a system, you're eventually going to consider this. So I'm glad we covered this topic, and I think we covered it well. And thanks to Day Trading Zoo for the question to make us think about this topic. So yeah, appreciate that.
Yeah, we always appreciate all the user feedback we get because we read it and sometimes it helps us figure out what to talk about this week. So I love it because, yeah, it made both of us kind of chat about it and then think and then bring it to you guys. So thank you all for tuning in, and I'll talk to you next week.
See you next week on Line Your Own Pockets.